Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Monday, the 30th of January. I'm Daniel Lam, your host for the podcast. This week is the week for macro data. Starting from Tuesday, we have the Chinese official manufacturing and non-manufacturing PMI. Following that, we will have the US ISM manufacturing data on Wednesday. Thursday will be the central bank's decision date, starting with the Fed in the early hours in Asia, followed by BOE and ECB decisions in the evening. Finally, on Friday, we've got the China Caixin PMI and the US non-farm payrolls. Now, risky assets have rallied in January because the peaking headline inflation and the slowing, but not sharply slowing, growth numbers. This has led to the narrative that the Fed and the ECB may soon do a policy pivot on their aggressive rate hikes. So the question in the mind of many of you is that, should I be locking in some profit? Our short answer is yes, especially in the assets that have been leading the rally, which includes European and Asian ex-Japan equities, Asia local currency and Europe high-yield bonds, industrial metals, gold, and the Aussie dollar. Our proprietary indicator shows investor positioning has become very crowded in these assets. Now, many of the key bellwether risky assets are also running into some major resistance levels. For example, the S&P 500 is running up to the important 4100 level that we've been highlighting. The DXY, meanwhile, is hovering around the 102 level, while the Hang Seng Index is at the resistance zone between 22,600 and 22,700. Macro-wise, we do not believe that the Fed and the ECB are likely to pivot yet, because the job markets remain hot. Remember what our CIO team had been talking about last year, about the Fed experience back in the 1980s. At that time, Fed chairperson Paul Volcker stopped the Fed rate hikes too soon, and inflation ran out of control again, leading to more painful rate hikes down the path. We do not believe the Fed is likely to risk that scenario again this time. Now in Europe, the pleasant surprise from the weather, which has helped revive consumer and business confidence, raises the odds of a more hawkish ECB. A hawkish ECB, against the backdrop of stretched technicals, would challenge the euro area equity rally. As such, investors should stick to the safe portfolio that we suggested and concentrate upon income assets for the near term. Meanwhile, they should wait for opportunities arising from the potential consolidation in the aforementioned risky assets. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.